We haven't spoken a week. A week ago, we talked about what we were forecasting with Jackson Hole, but it doesn't matter what we were forecasting at this point. Let's look at what we got and the other important things that developed in the economy and with inflation, actually, and discuss this. So we're ahead of the game. We've got good market analysis, and we know how to position because I think we've got a pretty good read here, and we've got plenty of notes today to discuss. So we're going to start by discussing the Fed, and then we're going to get into the economy. So we'll start with the Fed. The focus was having to hike more than needed today. This was not a dovish meeting. It wasn't, we're thinking about pausing. We've done a lot. We've seen a lot of progress on inflation. That was not the tone. Those were not the words. Powell actually never even used the word cut today. Anyways, his read on the recent data that we've gotten is not that these are great signs, we're headed in he didn't even use the term we're headed in the right direction. He didn't even acknowledge the direction, and more on the direction that inflation is going later. But first, he didn't acknowledge the direction. He said 2 months of this stuff is the beginning of what you would need to see to start to see inflation starting to head towards our 2% target. But then he and Mester and all the rest of the Fed speakers were consistently talking about how inflation is too high still, despite the data, despite the bulls trying to claim victory, despite the bulls saying they're done, despite the bulls 6 months ago saying they were going to over-tighten and they needed to stop hiking and all this stuff. Believe it or not, Mester said today, she was the last Fed speaker, this was her going out, that the bigger risk was under-tightening versus over-tightening. So if the question is whether or not they're going to hike one or more times, if that is what you're making your decision on, which I don't think is an important decision because there's going to be plenty of other things we're going to talk about later, it seems like they're going to hike again. That's what it seems like to me. It seems like they don't want to make that decision. They don't want to announce that decision before the meeting. But the indication to me today is not that they're leaning towards the inflation is in the bottle. It's we're leaning towards inflation is not in the bottle, and there's some data that we'll discuss in a second. Even those who don't want to hike again, Goolsbee, Harker, they think that we've done enough. They say the battle isn't over, and they want to hike again if progress on inflation stalls. Not even if inflation ticks up. Just if we stay flat, just if progress stalls, if we stay at this 0.2 to 0.3 month on month. But we're not looking at a 0.2 to 0.3 month on month right now. When you look at the Cleveland Fed nowcast, we're looking at 0.8% month on month for headline CPI. Now, I get that's not that important, but let's remember, the target is 2%, and we're getting 0.8% month on month. So all that progress, all that enthusiasm, 0.8% month on month, that is a 2022 number. That's the kind of number that you multiply that number by times 12. What do you get? You get a higher inflation rate than we've had the entire time. So definitely an important thing. I think it's a very, very not dovish meeting today. And I think the market is struggling with that digestion. We obviously saw the initial rip once the speech came out, once he started speaking. And then he started talking about the economy, needing to see some sort of recession. Then we pulled back. Notice also that he wasn't saying the rise in the 10-year might do some work for them, saying that he's concerned about that, saying that he needs... No, that wasn't part of the speech. There's a lot of things that he didn't say that were important. But here's the kicker. Stocks, very emotional, very volatile, not always logical. Bonds, very logical, very simple thing to price. You're just pricing the Fed and you're pricing inflation. Simple things like that. Very, very macroeconomic. Fed funds futures ticked up today. Meaning, one, the probability of a rate hike this year went up today after the Fed spoke. We can see that in the Fed funds futures. We can see that in the 2-year. but also forecasts for rate cuts towards the end of next year came down, meaning in the market pricing, just initially after the Fed spoke, less cuts expected next year. That's pretty big if you ask me. I think a lot of bullish narrative is built on that. A lot of enthusiasm is built on that. A lot of optimism is built on that. And a lot of the economy that we'll get to later in the video also built on that. Mester went as far as to say no cuts at all next year. It's her forecast. Powell never mentioned cuts, and the real rate will continue to go up as inflation continues to fall. Ultimately, they want and need the economy to slow. They need below-trend growth. That is part of the process of getting inflation down. Because let's not forget, when the economy performs above potential, before inflation, without inflation, or even with inflation, as part of the normal economic cycle, this almost always occurs, the Fed begins to hike interest rates. That's what they do. That's what they do when the economy is performing above potential. They don't want things to be too hot because then inflation follows. That's what happens throughout history. That's what they know. That's what they believe. They don't want inflation too hot. They don't want inflation too cool, or they don't want GDP too hot. They don't want GDP too cool. So GDP is growing above potential right now. It's been growing above potential all year. So they're in no rush or anything to cut. They actually want the economy to slow. That is what they want. They need that. They need that to move on to the next few phases that the bulls are very much hoping for, that they're almost acting as if is right next door, as they have been the entire time. And it's been ridiculous. It's been very painful for me, who's trying to be logical, but somehow the economy stays strong. I don't know if that is the wealth effect. I don't know if that's the equity markets kind of building on itself. But that's what the hand we're being dealt. So I see no reason for the Fed to slow down the hikes or slow down the desire to tighten or any of that. I think one is pretty much locked in. I mean, obviously it's not locked in, but I think it's very likely that we're going to get another hike. And I think it's more likely in September than November. But either way, I think it's going to come, particularly after this next inflation data. But they need to also get an unemployment up to 4%. That is still below the traditional definition of maximum employment. That is not a major move in unemployment. But despite employment being so low, and this is where we're transitioning into the things that are highly questionable, raise many questions within the economy. Despite unemployment barely budging, remaining very low, auto loan delinquencies amongst subprime customers are currently above 2008 levels. Think about that. Right now, in this Goldilocks economy, where everything is going fine and dandy for NVIDIA and Microsoft, and somehow we're extrapolating that to the rest of the economy, while LA port volume and Houston port volume are near, 5, almost 10-year lows, subprime auto loan delinquencies are surpassing 2008 levels despite virtually no rise in unemployment yet. Okay? Additionally, you're seeing Macy's and Nordstrom reporting delinquencies rising and expected to continue to rise. Why would this be the case? Why would this be the case if the economy is so strong? You've heard about these excess consumer savings, right? Well, guess what? They're now no longer excess. JP Morgan recently put out data when accounting for inflation, the excess savings have now gone negative, meaning excess savings are now depleted. Additionally, you've seen real wages decline. That is why you're seeing this kind of consumer stress. Yes, I'm calling it consumer stress. That's what it is. I just read you the facts. I just read you the statements from those companies. I just read you the port dynamics. I just read you the subprime auto loans. That is consumer stress. That is before an increase in unemployment. That is before the full effects of the tightening are yet to be felt. So I think the Fed is going to get the recession or the slowdown in GDP they are looking for. I'm seeing the signs of that. The market doesn't seem to think that. The market seems to think that we have troughed and we are accelerating and off to the races. I think a landing will occur of some kind. There will be some sort of landing of the plane, meaning a recession. And yes, a soft landing can still mean a recession. A no landing is what the market is thinking right now. That inflation just comes down and the economy never slows and we just keep going, we just keep gliding. I'm not seeing that. I don't think the, highest subprime auto loan delinquencies in several decades is a sign of economic boom. I think what's going on right now is super weird. Apparently, the Taylor Swift and Barbie and Oppenheimer movies alone are adding 0.7% to GDP. You're about to potentially get some auto factory worker strikes and auto factory strikes. I don't know how much it's going to impact GDP, but I don't think it's going to be nothing. So we'll see what happens. Finally, to have the anti-bear, no recession camp sentiment, I'm begging you guys, just please cool it for a few more months. Final point right here, and then we'll be done. We're still a few months away from the average time it takes to get a recession after the first rate hike, traditionally, historically. However, it might be on the longer end, so you might need to give us several more months, given we're coming from zero, the zero lower bound, and we had such aggressive stimulus. So we're not even at the average time it takes for a recession after the first rate hike. That is painting the picture of the lags. We're seeing some signs. I'm discussing those signs with you. I'm not willing to get on that no recession camp yet. I'm not until we're well deep into that. And maybe I'll be the last one, but I'd rather be the last one, buy late, be in energy that I think is fine to be in, than to buy and then be down 30%. Okay? It's a very difficult market. We'll give them that. We'll give myself that. All right, patting myself on the back. Haha, excusing myself. No, I'm not. But this is my analysis. This is what I'm thinking about. This is what I'm looking at. That's today's video. And until next time, peace out.